I regard Alibaba as one of the worst mistakes I ever made.
Charlie Munger recently gave some thoughts on his investment in Alibaba, the Chinese e-commerce giant. Charlie Munger is vice chairman of Berkshire Hathaway and Warren Buffett's business partner. He's a big believer in concentrating heavily or betting big when very attractive opportunities present themselves. He bought $37 million worth of Alibaba shares in the first quarter of 2021 for the Daily Journal. Charlie was chairman of the Daily Journal at the time, and he bought the shares at an average price of $227. 2 years later, in February 2023, the share price stands at just $90. That's a decline of 60% since Charlie made his investment. Now, some investors have blamed the poor performance of Alibaba on the Chinese Communist Party and Jack Ma's political downfall. Jack Ma gave a speech where he criticized the government, banks, and regulators. That led to a lot of scrutiny for Alibaba from the government. The Ant Financial IPO was pulled and Jack Ma disappeared from public view.
Well, of course, it was a very interesting thing. Jack Ma was a dominant capitalist in Alibaba. And one day he got up and made a public speech where he basically said the Communist Party is full of malarkey. They don't know their ass from their elbow. They're no damn good and I'm smart. And of course, the Communist Party didn't particularly like his speech. And pretty soon he just sort of disappeared from view for months on end. And now he's out of BYD. It was pretty stupid. It's like poking a bear in the nose with a sharp stick. It's not smart. And Jack Ma got way out of line by popping off the way he did to the Chinese government. And of course it hurt Alibaba.
But Charlie himself admits that it wasn't just the Chinese Communist Party that led to the investment failing. Even at the time of his investment, there were signs of deterioration in Alibaba's business. From 2015 to 2021, gross margin fell from 69% to 41%, and operating margin fell from 30% to 13%. And these margins continued to decline after Charlie invested, reaching 8% in 2022. Charlie Munger himself admits that he was charmed by the idea of Alibaba leading the Chinese internet, but forgot to remember that they were still a retailer and that e-commerce would be competitive.
In thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a retailer. It's going to be a competitive business, the internet. It's not going to be a cakewalk for everybody.
Part of the reason for that decline we saw earlier in Alibaba's margins is that it was using the profits from its online retailing business to fund a host of new businesses. The core e-commerce business had been growing nicely, in fact, but those profits were reinvested into other parts of the company. These other businesses, like the cloud business, digital media and entertainment, and innovation initiatives, were loss-making, and that dragged down the group's profitability. These businesses' losses have grown from 26 billion yuan in 2017 to 69 billion yuan in 2021, which has been a drag on group profitability. Meanwhile, new innovative businesses like Pinduoduo have started to take market share within the Chinese e-commerce market. Charlie Munger is down about 60% on his Alibaba investment in 2 years, and he regards it as one of his worst mistakes ever. Perhaps we can look back now and say that there were signs at the time of the investment that Alibaba had some challenges, but of course these things always seem perfectly clear with hindsight. So that was a brief rundown of Charlie's investment in Alibaba. Thank you for watching, and if you have any comments or questions, feel free to leave them below.